Hello everybody, Glenn Tompkins here on our VectorVest channel. Welcome back to our next video in our series, Stock Market for Beginners. Hopefully you're getting a better understanding of what investing is. Now we need to talk about why it's important to invest. In the last video, we talked about growing your wealth, and that's pretty much the crux of what investing is and why it's so important. We want to teach you how to become financially independent, and a lot of things can affect how we make money. Things like, how secure is your job? Are you making a livable wage? Are your wages keeping up with inflation? Can a pandemic affect your financial situation? Financial freedom comes when you don't have to rely on working for someone to make money. Investing keeps you in control of your financial situation. Financial freedom is a journey, and you don't get to that destination in one day or one trade. Investing doesn't always have to come with upfront costs associated with it. Now, yes, it takes money to make money, but if you have a plan, trade that plan. You can easily grow your wealth in a nice, steady way. There's a few things to keep in mind when investing. Capital. How much do we have to invest? Return. How much money are we making on the money that we invested? Time. How much time are we investing for? Because time equals money. The next question you may have is, how much do I need to start investing? And that's a question that I hear a lot. I'm getting ready to rock your world with some good down-home analysis that's realistic. All right, so in a minute, I'm going to open up a realistic way for you to understand how much money you can save and what it does, how much money you take the same amount of money and invest what it does. All right, so let's do this. Here's a compound interest calculator. Interest, return, whether it's return on investment or return on the money that you've invested in by way of an interest rate. You put your money in the bank when interest rates are good, you get a little bit of money back. In this particular point in time, the interest rates are low because the market needed to be spurred up and propped up. So we have low interest rates at this particular point in time. But I'm going to use the same word for interest as I would for return on investment. So I'm going to reduce it down to the ridiculous. Now, in regards to how much money you need to invest in the market, let's say we have an initial investment of zero. We have no money to start off with. Do you know that if you could put $2 aside every day, $2 aside per day, you'll come up with about $60 a month, all right? From an investment standpoint, that's not half bad, and that doesn't take away from the money that you need for your consumables. Remember that in the last video as well? This is the money, the consumables are the stuff that you need to live on. But this is above and beyond that. $2 a day will yield you $60 a month. So monthly contribution, let's say it's $60 a month. The length of time that you're trying to save this money for in a working time frame is about 40 years. We work for about 40 years before we're done and we retire. So I'm going to put down the length of time in years, about 40 years. With the current interest rates that we have right now, if you were to take that $60 monthly contribution and put it in the bank for 40 years right now, interest rate right now is at 1.2%. It's not a lot, all right? Interest rate variance range, I'm going to keep that alone. But the compound frequency, once a year, we're going to look at looking at your interest rate compounded on an annual basis. All right. So you start off with no money. You put in $60, length of time, 40 years, just doing that over and over and over. I'm going to calculate that, what that would look like. Wow. $36,000 in 40 years. That's not a lot to retire on, right? $36,000. And that's reducing it down to the ridiculous of just $2 a day. All right. Let's do this. Currently, the interest or return on the S&P 500 is about 8% a year. Let's say you now do this instead of putting it in a bank, you put it in the stock market for investment. Estimated interest rate, and this time I'm going to call this return on the money that you invested. I'm going to change that from 1.2, and I'm going to put it to a reasonable number, and I'm going to say 15%. Now, many of you will be like, holy smokes, I can't do 15%. We can show you how to consistently outperform the market. at the rate of at least 15%. So I'm going to put the estimated interest rate at 15% a year. I'm doing this 15% a year, same numbers. All right, let's calculate it. By the time I'm ready to retire, look at the difference. Look at the difference between saving your money and investing your money, and it yields a much bigger return. $1.2 million in a year, compounded interest. Holy smokes. Now you get a better understanding of why investing is so important. All right, let's do this. Instead of saying, let's say you could put away a little bit more money. Let's say you could put up $5 a day. Man, I'm still keeping it low. $5 a day. That would give you, on a monthly basis, about $150 a month. Let's do that. $150 a month. That's based off of $5 a day. Same amount of time we're going to invest in for 40 years. All right. And let's go back to saving it. So we're going to put it at a 1.2 rate of interest on saving it, putting it in the bank. Let's calculate it. Now, we should get more money, right? So $5 will net you about $91,000 after 40 years. Well, that's better than just $30, right? $30,000. Is that still enough to retire on? Folks, that's just putting up $5 a day, putting it in the bank at an interest rate of right now about 1.2%. Let's do this again. Still $5 a day, putting in $150 a month over 40 years. Let's do the same thing. What if I can grow it by 15% a year, knowing when to buy, what to buy, and when to sell on that $5? Let's do a calculate now. Holy smokes. Investing turned it from $90,000 a year, or $90,000 after 4 years, from saving to $3.2 million on that same $5 a day investing. Hopefully this is opening your eyes more so to the reasons of why investing is so important. And the numbers that I use are realistic numbers that people can use, especially if you feel you do not have a lot of money to invest in the market. Remember, you can work from paycheck to paycheck, but if you are growing your wealth by investing it, you're doing much better than the person that's got $1 million a year and spends all of it on consumables. All right, so that's the numbers by way of calculating the numbers. I'm going to now get us into the VectorVest software and show you how to apply these same numbers to trading systems that we automatically have set up for you. All right, so now I'm going to get into the VectorVest software. And right here, we have what we call model portfolios. These model portfolios tell you when to buy, what to buy, and when to sell. It is a trading plan that you can actually trade right now based upon those two numbers that I gave you on whether you're putting in $2 a day or $5 a day for your investment. Now, I've got 3 model portfolios I want to take a look at. Here's one that's up 212%. It's been in effect since January of 2014. That's not bad at all. Model portfolio number 4 is up 100 and up. That's not the one I want. That one is up nicely, but it's a lot more jagged. I'd rather have you in one that's a lot smoother, like model portfolio number 3. Since January of 2014, a lot less jags in the equity curve. And that's important because I want to be in a trading system that I can feel very comfortable sleeping at night. What's this big pullback in the market right here? This is COVID-19. But look how nicely and resilient this portfolio was after that fact. All right. And that happened in all of our portfolios. Let's go to model portfolio number 2. All right. Up 317% back in 2020. There's the pullback in the portfolio. But again, resilient return or move against what happened back in COVID days. So folks, I wanted to show you that these portfolios are in effect. These are in the system for you. Now I'm going to take you a step further. Those 3 portfolios, model portfolio number 2, model portfolio number 3, and model portfolio number 5. Let's put that into practical application with if you could put away $2 a day or if you could put away $5 a day. let's go to the backtester. So in the backtester, I simulated some tests, starting with what I would call the stock market for beginners, that's the SMFB, utilizing a $720 portfolio. I'm going to assume that I had the first year's money put away, and that I could start off right now with $720 in the market. All right, boom, I put it in. I utilized the terms based on the model portfolio number 2. All right, it's got a timing signal. This is looking over the last year from 11/16 of 2020 to 11/15 of 2021. No matter when you're watching this video, the dates don't matter. What I'm explaining to you is how to take that $720 a year on $2 a day, putting it aside, or $1,800 a month based upon putting $1,800 a year, putting aside $5 a day. All right, that's what I want to get across to you. Don't worry about all of this stuff. This is just for now, but I want you to understand that from a realistic standpoint, it can be done. $2, model portfolio 2 with $2 a day for a month to a year. It comes out to $720 a year. Look at that. Annualized rate of return of 14%. What did I tell you could get? 15%? You're just about right there. That's not bad. So you turn $720 into $821, 14% annualized. Look at that drawdown. The drawdown represents the most amount of money you had to lose in that portfolio. Especially if I'm newer to the market, I want to try to lose as least amount of money as I possibly can. I'd like to see my max drawdown below 10% if possible, and the majority of these portfolios are right in line with that. How about we take that same $720 and utilize the rules that are set in model portfolio number 5? 28%. Remember, we're only working with $720. $720. We made 28% with a max drawdown of 12.91%. And then if I look at model portfolio number 3 with that $720, look at that, 24%, still getting higher than that 8% that you get on an annual basis with the S&P 500 with a drawdown of 9.77%. Here's the equity curve. All right, let's bump that up. Let's say that we could put $5 away a day, every day, all right, which gives us about $1,800 for the month. We had the money, we could start out $1,800 a day. $1,800 for the month. $1,800 going into the market using the rules from model portfolio number 2 gave us 33% annualized return over the last year. Look at that drawdown of 5%. Look at that equity curve. This just made money on top of money on top of money based off of an $1,800 portfolio, went up to $2,300, $2,400. Man, that's real. Let's go look at the same $1,800 on the rules from model portfolio number 5. It made us 41%. Look at that, 41% with a drawdown of less than 10%. But took that $1,800 in a year, turned it up to $2,500, 60% winning trades. Look at these. All of these trading systems are at least 50% except for the $720 on model portfolio number 3. Gave us 43% winners. But being able to take that lower dollar amount of money and be able to switch it and turn it up like this is no joke. And let's look at the $1,800 based off of model portfolio number 3. We made 27.5%. 13, a little bit of higher drawdown and had a little bit more pullback in the portfolio, but still outpaced what the S&P 500 does over a year period. So with that, folks, this is why it's important to invest in the market to help you to grow your wealth as opposed to just putting your money in the bank. So folks, I'm hoping that this hit home with you. If you like this information, again, please share these links with people who are your friends or your family who are wanting to learn more about how to invest in the market. So folks, I love this series. Hopefully you are as well. Hit the like button. Man, hit the like button. Let me know that you like that. And not only that, give me your feedback. Let me know in the comments how you like the videos or what we need to add to it. With that, folks, this video is over. And until the next time, see ya.